Good afternoon and welcome to this week's Halftime Talk. I'm honored to be joined by Mr. Ed Morse, the Global Head of Commodities Research at Citigroup, recognized globally as one of the best crystal ball gazers in the energy industry, and no better at the end of such a turbulent quarter and sitting ahead of a somewhat hopefully better one. I'm going to kick off, Ed, with the easy question. What do you take out of this quarter? Is there positive signs? What's the legacy inevitably of Q2 2020 when the world changed?
Sure. Well, undoubtedly the earmark of the quarter is still the biggest demand shock in the history of the oil industry or the history of the world. And that's not going to go away. But in retrospect, I think the demand shock was a little bit more mild than people had feared it was going to be. And I think the action and reaction on the supply side was, in fact, a little bit greater than people thought it might be. So I think with this being a quarter that saw, by accident, oil pricing negatively on the New York Mercantile Exchange, we have the elements of what could be a very good rest of the year, and especially a very good third quarter. We're going to be moving almost certainly from a period of really dramatic, maybe unprecedented inventory builds to something that's very different. And that different issue on the demand side is higher demand, less supply, and a market that might tighten up very, very rapidly depending on where the current surge in the U.S. coronavirus situation goes, and depending on a couple of other factors in the world.
We would say, I mean, there's probably a bouquet of strings to pull from as to what was the biggest player in the second quarter, putting COVID aside, but ultimately inventories building massively, the incredible collapse in demand and so quickly, and then the unprecedented cut in supply. I mean, which one of those would you identify as the game changer, as the one that shut us down, turned us around? What do you think stands out to you?
So undoubtedly what stands out, and which I do think is a game changer, we don't know for how long it will be a game changer, but what really stood out was the involvement of the what we call the bear, the elephant, and the camel. Russia, and I didn't mean the elephant, I meant the eagle. Russia, the United States, and Saudi Arabia actually recognizing that they were extremely interdependent upon one another as suppliers in a market in which there had been a demand collapse. They were mutually vulnerable to a situation that led them all in grave danger, and they needed each other to get out of that hole that had been dug, without getting into the factors that led to that hole being dug. But certainly the demand collapse was part of it. So I think without the U.S., Russia, and Saudi Arabia having found a way to act together with one another and to coax other countries along with them, we would not have gotten out of the situation. The world would not have gotten out of the situation as rapidly as it might well be the case now. And the question really is the durability of that recognition of mutual interdependence.
It's somewhat unprecedented that a U.S. government would be advocating for higher energy prices. A very rare moment that those three players would have alignment. Does that sustain?
It sustains depending on who's in power, what their interests may turn out to be, and how the world evolves. I think it sustains for quite a while. We'll see whether there's any real institution building that goes on around it to cement it. But at the moment, if you look at the capitals involved, Washington, Riyadh, and Moscow, there is real concern about what the recession will look like, how difficult or easy it might be to get out of that recession. I think that will keep them communicating with one another. Certainly for Russia, Saudi Arabia, and some other big producers in the OPEC Plus group, they've moved to monitoring the market on a monthly basis. They recognize how precarious the the recovery is turning out to be. On the U.S. side, I think the recovery is actually a lot more precarious than people had hoped or planned it to be. So I think that momentum, really does continue. Let's see whether either through the G20 or through some other mechanism the U.S. can be brought into regular monthly meetings. After all, this did happen with the great financial crisis. It led to the G20 being established to begin with, recognition that central banks in particular needed to pool information with one another more frequently and in a very politicized way. And I think there is some hope that
is it working? Does it work for America or for the US because oil prices are only $40 a barrel and so not doing any real damage to the US economic recovery? If prices were to get higher, would that be problematic for a president to still advocate for higher prices?
It would be problematic depending on the circumstances. I think it would be problematic for everybody involved in this world if prices got to be at the level they were at a year ago. I actually think that $70 is not sustainable, and it's not sustainable partly because of the nature of the U.S. shale industry, partly because of the nature of the global business. I think there is a little bit too much hope, for lack of a better word, when the IEA talks about this drop in capital spending in the oil industry, setting oneself up for potentially another spike in oil prices and another period of high prices. I think at the end of the day, that's wrong. I think that at the end of the day, the new technologies that were developed in the first decade of this century are here to stay. It means that you can find and develop oil faster than anyone had reckoned would be the case 20 years ago. Hitting a dry well is, dry holes don't happen these days because seismic science has gone to the level that it's gone to. The real technological breakthrough was after 160 years of exploiting reservoirs. And you might say it's at the margin, but it's really very important. A whole new source rock was proven to be commercially exploitable, and the short cycle nature of exploiting it is really a phenomenal lesson that should not be forgotten. $70 oil will bring us faster back to $30 oil than $50 or $60 oil will. So I think.
So where do you see shale coming out of the second quarter? We've seen the rig count in the US collapse dramatically over the last 3 months. Would it be fair to say it's kind of bottoming out, that US production is reaching a floor, or do you think there's more downside?
No, I think there's very little downside. It may be an accident of the data. We're having stabilization of the rig count. The rig count's going to start to grow slowly at first, but then pick up speed. There's already a pickup in fracking, so the number of frack crews out have gone up for the last several weeks in a row. So there are more wells being completed. Certainly at $35, $40 WTI, there is profitable oil to be exploited. It's not a level at which the system can grow, but 45, 50 is certainly a level where the system can grow. And we think we'll be at that price level by the end of the year. We think the rig count will go back up, not to where it was at the beginning of the year, but driving from a 200 rig utilization rate for oil directional drilling really is a floor. And by this time next year, we think it'll be back to 550 or 600 rigs, and production should grow next year. The question is really by how much and how disciplined will the U.S. shale producers be. We think they're likely to be very disciplined, and it won't be unless there's a price level that's in the $60 range that they'll overdo it again and spend too much of the cash flow on drilling again.
What price point would they need to get to that picture you just painted, 600 rigs and?
Yeah, so let me just talk about the major lesson in the world, and that is that the cost curve, the supply curve for oil, has flattened tremendously. That's been driven by technology. and it will attract capital depending on what the price is. But we estimate that at $40 Brent, the world as a whole, so that includes Saudi Arabia and the UAE, it also includes deep water and includes oil sands, that at $40 a barrel, the world will not be producing incrementally enough oil to stem decline rates. So 2.5, maybe 3 million barrels a day of incremental supply, gross, not net, of declines over a 5-year period of time. At $50 a barrel, and that's the magic of this technology, at $50 a barrel, we think that production can grow by 16, 17, or 18 million barrels a day over a 4 or 5 year period of time. So there's a very finely balanced market. And the real question for those who are looking for price stability is whether you got to be very careful about the point at which you think the market is balanced. And the data really point to $45, $50 a barrel on the cost structure of the industry for the world as a whole.
In terms of coming out of the second quarter of 2020, it feels like the supply side of this great tumultuous quarter that we're just finished has kind of sorted itself out. It's big dramatic cuts by all of the major producers through an organized cut, and then the market doing the rest. And that the question in third quarter is really demand rather than supply. OPEC's kind of got off the news. Would you subscribe to that narrative, or what's your own sense?
So partly, I mean, the demand side is much less certain than the supply side in a lot of ways. The world has lost a lot of demand. If you look at where demand is now, where we think it'll be by the end of the year, we certainly don't expect that late 2019 demand can be reattained until late 2021. That's 2 years of effectively zero demand growth. So to the degree that producers come back to the market too quickly, it will not be able to generate, inspire, incite, incentivize a lot more demand, because the demand loss that we've had is not related to the normal drivers of supply and demand. This is not price driven. It is recession driven. It is unemployment driven. It's driven by a incredible drop in demand for transportation fuels, aviation in particular. So jet fuel demand, even if demand returns to the market in 2019 levels by the end of 2021, nobody expects jet fuel demand to be anywhere near where 2019 levels are. And indeed, they may never be back to 2019 levels. And I, judiciously use the word never. Just if you look at the drivers of jet fuel demand, there's engine efficiencies that are permanent. There are travel changes that look like they're going to be permanent from the business traveler, and the business traveler is the traveler who travels the most in terms of the most frequent travel is done by business travelers. It's not the percentage of business travelers at any one moment in time. It's the level of business travel. When we expect it could be down by 25% on a permanent basis because of the way we've learned to do Zoom calls and to remote in, and changes in habits that are not going to go away. And then there's, the IATA met in May and reaffirmed their movement, their CORSIA plans, as they call them, to use sustainable fuels to get rid of the percentage of the fuel in a jet that is created by a refinery, and have more coming out of the biofuel set of mechanisms. So it well may be that demand is going to be curtailed. So I'd say, yeah, demand is important from the base of the loss of around 20 million barrels a day in April, but nobody expects it to be back to 101 million barrels a day for another, maybe 15 to 18 months. So the supply side is critical. And on the supply side, we've had 3 different kinds of losses of supply. We've had curtailments that have been done by OPEC Plus and by a number of producers in North America. These curtailments are readily available for coming back in most cases, not in all cases. Then there are low flow
That's
wells.
kind of like the $1 million question for Middle Eastern watchers is how quick can shale return to work?
Well, it's not just how quick shale can turn to work. We've had a loss of shale. So it's how low is the production going to be? And we know some producers are coming back, but we know that, shale is high initial production, high decline rates. And with this lack of drilling, what's the production level going to be? So the production level peaked just under 13 million barrels a day, according to the revised EIA data. EIA last week had US production at 11 million barrels a day. That's down almost 2 million a day. We think it'll be down further than that by this time next year. Some of it will be on the shale side. Some of it is low flow wells. So it's not clear whether US production is going to settle at the base at 9.5 or 10.5 million barrels a day. That's a hole. It's a permanent hole. And yeah, US production is going to come back, but not overnight. And it will take a lot of drilling and maybe until the middle of this decade before US production reaches the level it was at in January and February. So that's one factor. Another factor is low flow wells around the world. And the US has got a phenomenally large number of wells that produce less than 25 barrels a day, or order of magnitude 800,000 barrels a day come out of these wells. We reckon that 500,000 of these are really lost forever. Even within the OPEC plus group, we have countries like Iraq that are strapped for cash, where they have service contracts with international companies that require the state companies to put capital up front. They can't afford to do it. How much capital spending is going to be curtailed for how long in Iraq, and what will that mean to Iraqi capacity? Russia is very complicated on this. Nobody expects Russia to get back into the market at the level they left the market. That has to do with oil fields that were shut in, that were not greenfield, but greenfield projects that are being run, they're running out of them. And
so it's kind of like low supply all over the world, where the recovery is difficult. One of
Absolutely.
the things that seemed to stand out in the second quarter, which I'm keen for your view as to where it goes in the second half of the year, it's been around a while, this China-US face-off, and the markets have been quite sensitive to it over the last 2 or 3 years with the trade dispute and then the resolution, and both the equity and the commodity markets. I'm wondering, what's your outlook for that face-off and its impact vis-a-vis commodity, oil demand, prices, etc., in the second half of the year?
Sure. So we've got to recognize that U.S. trade policy has not been good for the world. And it's not just the U.S.-China trade policy, but it's U.S. government questioning the equity of trade rules. It's U.S. government questioning whether fairness has been in the market, not just in U.S.-China trade, but U.S.-Mexico, U.S.-Canada, U.S.-Europe, U.S.-Japan trade. And the U.S. started putting up trade barriers, and it did so with a vengeance starting in 2018. We have seen in the presidency of Donald Trump trade expansion at the very beginning. That trade expansion got to be fairly robust in 2017, 2018. That was a period of time, if we want to go back and remember, when we were all wrong about oil demand growth, and we were wrong because we hadn't factored in a doubling of the rate of growth of trade, oil side notwithstanding, but container ship movements doubled on an annualized basis. Everywhere you looked, jet fuel demand associated with air freight doubled. And then the trade wars began, and then trade growth started to slow down from 6-7% to 3% to 2%, starting out 2019 at like 1 or 1.5%. By June of 2019, global trade turned negative, and it's been negative month on month, year on year, ever since June 2019. And the coronavirus has been part of that. But our drop in demand has been an extra good 500,000 barrels a day, more than it otherwise might have been, had a trade not started contracting the way it did. And yeah, we've got now a new US-Mexico-Canada agreement. We have some bright spots, maybe. We've got phase one of US-China. Demand is not going to return to their old rate of growth unless there is a return to trade. And that's kind of critically important for oil producers, and it's important for the global economy. How does US-China fit into that? Well, not well. And it doesn't fit in well because I think that beyond whatever we might think of the trade war being a particular Republican or Trump administration policy, it's become a little bit more permanent in the US. It's become a little bit more of an issue for China's main trading partners, including European trading partners and especially trading partners in the neighborhood that have also looked to the one-sidedness of trade deals with China. So I expect that that's going to continue globally. I expect that the military aspect of it, namely the state-based R&D in China that has led to China catching up with the rest of the world technologically, is going to have some backlash that will affect the trade front as well, no matter who the U.S. president is going to be come November. So I think trade is fragile. We've got to find a way to get it on another foothold. I'm optimistic that it will be, but for the two big giant economies of the world, the U.S. and China, I don't see any easy resolution to the underlying elements of the trade dispute.
In the other big factor of this second quarter, and maybe it's been around a while, but nonetheless, everything seemed to get heightened in the second quarter. We had the great financial market crash and then the great financial markets recovery, the big V. And the commodity markets, and particularly oil, seem to get pulled along with that. I'm wondering, do you see that correlation? And how do you see it into the second half of the year? The financial markets look pretty ripe. Could they correct and bring oil with it? What's your outlook?
Yeah, so oil is corrected more than other assets. I mean, oil had a bigger hit on the demand side, so oil prices went down much quicker, much further than the prices of other commodities or the prices of other assets. And oil certainly has had the rebound with a nice correlation with the equity markets since the bottom in April, but oil has not gotten anywhere back to where it was at the very beginning. We think that the supply-demand balance, purely looking at where demand growth is, looking at supply curtailment, some of which, as we've just said, are voluntary, some permanent, is going to see the market balancing very rapidly. We think oil should get back to $50 a barrel by the end of the year on a Brent-related basis, and even 60 in 2021 because of the postponement of a lot of capital spending. I spoke about the postponement of capital spending in the U.S., but globally it's a good 30% down, and companies are not going to rush in to spend so long as there is available production capacity. So there might be a little bit of a gap in the supply side in 2023 and 24 that can keep prices, at the $60 level. But then at the $60 level, we think the other mechanisms are at work to bring capital back into the system and bring more production in. On oil and other commodities, we have to remember that all commodities, from wheat and corn to copper and nickel, no matter where you look at a commodity, it's energy intensive. And oil is the bellwether of what energy prices are. So just on the cost side, a rise in energy prices should give a bolster to the rise in other commodities. And we think that's mostly the case, certainly for the metals markets. China looms really large. The Chinese recovery has been very important in what we call a credit impulse and getting spending going again in China. We have some concern about what the durability is of Chinese growth, but the Chinese government's got a lot of quivers in its arrow case, and we can see credit being expanded. We can see infrastructure spend. So we think that the outlook for metals is pretty decent for the rest of the year into next year. We think most commodities we'll be seeing forward curves that are backward dated, meaning prompt prices are there at a higher level because the demand for the commodity will be there. So I think we will see investor flows coming into commodities again, other than in gold, which it's been, super healthy, as you would expect in a very risky world.
In terms of just wrapping up, Ed, into the second half of the year, we've talked about a number of the trends and how they might play out. One of the big sort of outliers, perhaps, in the second half of the year is the US presidential election. How does that play into all of this? And is there anything else you would identify that we should pay attention to that we haven't talked about regarding that could be an issue in the second half?
Yeah, so the first and foremost one is the coronavirus itself. We don't know how the epidemic is going to go. We see how the US is kind of the naughty boy on the street at the moment due to state and local government interaction and the president's desire to get back to work and play faster than medical advisors might have warranted. But we don't know what's going to happen with the virus. We don't know what's going to happen with the vaccines. I think the biggest wild cards really are mutations in the coronavirus and the development of a vaccine. And the world seems pretty much hell-bent on getting a vaccine into play once it is proven to be reliable. So that I think is the big one for the year, and it will change the course of economic growth and the nature of the recession in and of itself. And the other big one, of course, is the US presidency. And it looks at the moment as though there could be a Democratic sweep. We don't know that. We won't know it until November comes. There's a lot of oil industry impact coming from a potential Democratic sweep in terms of policy. So this is a group that is, as part of its platform, is the Green New Deal. The New Deal, a job platform of Franklin Roosevelt during the Great Depression. So we'll be seeing government poised to be putting capital into infrastructure and into new energy jobs. We don't know how anti-hydrocarbon it's going to be. And I think that is a pretty big wild card, but it's a big wild card on everything. It's a wild card on trade policy. It's a wild card on cooperation internationally. It's a wild card on.
One of the interesting comments I picked up recently on that Joe Biden, if he was elected, he might be actually in the big wheel of time seen as the savior of the US oil and gas industry, because it's been so reluctant to transition the great energy transition that it's on a pathway to extinction. And if there isn't some force that comes in and compels the sort of hydrocarbon industry in the US, the Exxon Mobils of this world and so on, to buy into the energy transition, they will eventually go bankrupt. But perhaps that's a conversation for another time. Ed Morse, Global Head of Commodities Research at Citigroup, thank you very much for spending your time with us today. Really great to have you on the first halftime talk of the second half of the year. And we'll have to check back in with you, and hopefully when you come back out to the Middle East again, and we'll see how all of these things play out. Clearly unpredictable times, but yet we'll have to see. But thank you, Ed, for your time.
And thank you. And if I can just close with one remark and an observation, the halftime report at halfway through the year might well be the week that the US turns from being a builder of inventory to a place where inventory is going to draw. So it's going to be a very interesting thing to look at in the next weeks.